The truth about IULs, scam or smart investment. Please hear me out, this is very important. You've probably seen so-called gurus shouting that IULs are a scam. But is that true or a half-truth? Today, we'll break down exactly how Indexed Universal Life, IUL, works, show the real pros and cons, and give you 3 quick checks before you sign anything. Hey everyone, I'm Cloud, your golden money pup. If you want clear, no-nonsense financial info for families and anyone tired of financial hype, here it goes. Let's get into it. Part 1. Let's review what is an IUL from previous videos. An Indexed Universal Life Policy, IUL for short, is a type of permanent life insurance that provides a death benefit plus a cash value account. The cash value can earn interest based on the performance of a market index, commonly the S&P 500, but your money is not directly invested in the stock market. There are usually floors, so you won't lose principal if the index goes down, and caps or participation rates, which limit how much of the index gain you actually receive. Part 2. Why people buy IULs, benefits. Lifetime death benefit, protection. It provides a death benefit for beneficiaries. That's the core product. Tax advantages. Cash value grows tax deferred, and in many cases, loans or withdrawals can be tax efficient when handled correctly. Policy in force, not a modified endowment contract. Death benefit is generally income tax-free to beneficiaries. Important, rules and edge cases exist. Market-linked upside with downside protection. You can participate in some stock market gains, subject to caps/participation, while having downside floors in many contracts that credit 0% in down years rather than negative returns. Flexibility. Premiums and death benefit can often be adjusted. You can take loans against the cash value. Part 3. The real costs and risks. Don't skip this. Caps, spreads and participation rates limit upside. If the index returns 20%, but the cap is 10% or the participation rate is 60%, your credited gain is much lower. That's how companies balance offering protection with paying returns. Fees and cost of insurance, COI, can rise. The policy charges for mortality and administration can increase as you age, which can eat into cash value if you don't plan for it. Complex illustrations can be optimistic. Sales illustrations often show hypothetical credited interest that assumes product features and rates remain favorable. Real credited interest depends on future index performance, caps, participation, and the insurer's choices. Regulators have raised concerns about how IUL illustrations are presented. Lapse risk and the MEC trap. If you overfund incorrectly or stop paying premiums, the policy can lapse and you could face taxes or lose coverage. Also, overfunding can trigger modified endowment contract, MEC rules, which change tax treatment of distributions. Part 4. Myth-busting. IULs are a scam. Myths and the truth. Myth 1. IULs are always a scam and everyone loses money. Truth, not true. IULs are legitimate insurance contracts used by many people for lifetime protection and tax-efficient cash accumulation, but they are complex and not right for everyone. Properly structured and responsibly funded policies can work as part of a long-term plan. Myth 2. IULs promise stock market returns with no risk. Truth. They advertise index-linked growth, but returns are limited, caps participation, and there are flaws, usually 0%. You do not get full market returns and you pay for guarantees. Myth 3. Agents only sell IULs to make commission. Truth. Commissions exist. Many products do pay agents, so buyer beware. That's why you should compare cost illustrations, ask for net of commission projections, and get second opinions. But commission alone doesn't make a product a scam. Suitability and transparency matter. Drop a in the comments if you want a short video showing how to read an IUL illustration. I'll break down the numbers line by line. Part 5. Evidence and market context. IUL sales have grown in recent years. Industry data shows record IUL new premium in 2024, about $3.8 billion, and increasing policy counts. So many consumers are choosing these products. Source: LIMRA Sales Report. About half of Americans report owning life insurance overall. Permanent products, like whole and universal life variants, represent important parts of the market. Part 6. How to evaluate if an IUL might be right for you. 3 quick checks. Get a conservative illustration. Ask the agent for a low crediting rate scenario and a baseline scenario. Don't accept only the best case projection. Ask them to show net of fees. Check costs. Request a breakdown of COI, administrative fees, rider costs, and surrender charges. If you can't get clear numbers, walk away. Think timeline and purpose. IULs are long-term vehicles. If you want quick investment growth or are on a tight budget, a term policy plus separate investing may be better. Part 7. Real examples. Mini case study. Case A. Young professional, 30. Funds an IUL with disciplined premiums, long time horizon. Tax-deferred growth plus death benefit can be useful for future loan flexibility or supplemental retirement income. Case B. Near retirement, 60. Cost of insurance high. If funding is limited, this can be risky. Alternative, consider guaranteed annuities or other guaranteed products depending on goals. Part 8. Final verdict and trust signals. So, scam or smart? Answer: neither blanket label fits. IULs are a legitimate tool with real benefits, tax advantages, lifetime protection, indexed upside, and real downsides, caps, fees, complexity, lapse risk. Whether it's smart for you depends on your finances, time horizon, and how transparent the agent and insurer are. We are a licensed insurance professional. We can run independent illustrations and show you conservative scenarios. If you found this helpful, hit like and subscribe and comment below. Thanks for watching.